Was this the week Meta secured its future in AI, or did investors just shrug? The company announced a historic multi-year partnership with Nvidia, committing to one of the largest AI infrastructure build-outs ever seen. Yet the stock's reaction was lukewarm, continuing a period of sluggish performance. With Meta betting billions on AI, why aren't investors betting on Meta? Welcome to TickerWatch News from Meta, Week 8, 2026. This week, we're looking at the major developments for Meta, from blockbuster hardware deals to high-stakes courtroom testimony. It was a volatile week for Meta, reflecting a broader market rotation away from mega-cap technology stocks. While the overall market has been mostly flat this year, Meta's stock has declined around 3% year-to-date and is down roughly 9% over the last 52-week period. The stock has been digesting gains from earlier periods, even as the company makes massive long-term bets on AI. This suggests investors are cautious, weighing the enormous cost of future growth against more immediate returns available elsewhere in the market. The takeaway is that despite a powerful long-term AI narrative, near-term concerns around spending are keeping the stock in a consolidation phase. The biggest story of the week was a massive expansion of Meta's partnership with Nvidia. The new multi-year, multi-generational agreement will see Meta deploy millions of Nvidia's AI chips in its data centers. The deal covers not just the current Blackwell GPUs, but also future Rubin and Vera processors. Notably, it also includes the first large-scale deployment of Nvidia's Grace CPUs as standalone units, signaling Meta is moving toward a full-stack dependency on Nvidia for its entire server infrastructure. This deep collaboration is the foundation for Meta's plan to build what it calls personal superintelligence. This partnership is part of Meta's staggering capital expenditure plan. The company confirmed it expects to spend between $115 billion and $135 billion in 2026 alone. This spending is aimed at building out the massive data centers required to support its AI ambitions. While the investment is intended to secure Meta's position as an AI leader, the sheer scale of the spending has raised questions among some investors about the near-term return on that investment. In a significant strategic shift, Meta also announced that its immersive world, Horizon Worlds, is moving to be almost exclusively mobile and is being explicitly separated from the Quest VR platform. This pivot positions Horizon Worlds to compete more directly with popular mobile gaming platforms like Roblox and Fortnite. The move follows reports of layoffs in Meta's Reality Labs division and signals a major reprioritization away from the metaverse and toward AI and mobile experiences. In the courtroom, CEO Mark Zuckerberg took the witness stand in a landmark trial concerning social media addiction among young users. During his testimony, Zuckerberg stated that enforcing age limits on Instagram is very difficult because users can lie about their age. He also sought to downplay the financial incentive for targeting teens, testifying that they account for only about 1% of the company's revenue. The case is being watched closely as it focuses on whether the platform's design, not just user-generated content, creates foreseeable harm. Finally, while some funds have been trimming their positions, billionaire investor Bill Ackman revealed a major new bet on Meta. His firm, Pershing Square, disclosed a new stake of approximately 2.7 billion shares, making Meta over 11% of its portfolio. This represents a significant vote of confidence from a prominent activist investor at a time when sentiment around the stock has been mixed. Investor sentiment on Meta appears sharply divided. On one hand, the new position taken by Pershing Square's Ackman, along with a boosted stake from David Tepper's Appaloosa management, provides a strong bullish signal. Wall Street analysts largely agree, with a strong buy rating and an average price target that suggests a potential upside of more than 30%. On the other hand, some major funds, like Lone Pine Capital and Renaissance Technologies, have recently trimmed or completely sold their positions in Meta. This reflects a wider caution among investors about the company's massive capital spending on AI and the potential impact on free cash flow. The stock's price, which is down over the past year, shows that the market is still weighing the risks of this spending against the potential long-term rewards. The narrative tone is mixed, with bulls seeing a long-term AI powerhouse in the making, while bears worry about the cost to get there. From a high-level technical view, Meta's stock appears to be in a digestive phase after a strong prior run. One report this week noted that the 14-day Relative Strength Index, or RSI, is sitting near 43, below the neutral 50 mark, which suggests momentum has softened but isn't deeply oversold. This indicates that while the long-term upward trend may still be intact, short-term momentum is fading as the stock consolidates. Fundamentally, Meta's valuation presents a complex picture. Trading at a forward price-to-earnings ratio in the low to mid-20s, it's priced at a premium compared to many sector averages. However, within the Magnificent Seven, some analysts consider it a valuation standout. Investors are paying for a company with unparalleled global scale, dominant advertising reach, and a clear, albeit expensive strategy to lead the next wave of AI. The core debate remains whether its massive investments in AI will expand margins and accelerate growth enough to justify the current stock price. Looking ahead, the most significant catalyst for Meta will be Nvidia's earnings report, scheduled for February 25th. Nvidia's results, and more importantly, its guidance, will provide the clearest signal yet on the state of AI infrastructure spending. Since Meta is one of Nvidia's largest customers, any commentary on demand, supply constraints, or the pace of data center buildouts will be a direct reflection of Meta's own strategy. The bull case for Meta hinges on its AI investments translating into higher ad efficiency and user engagement, a scenario supported by the recent partnership news. The bear case revolves around the risk that capital expenditures will continue to pressure profitability without a clear, near-term monetization path, all while regulatory and legal challenges continue to mount. Investors will be watching to see if the stock can break out of its recent consolidation or if concerns about spending will keep it range-bound. Thank you for tuning in to this week's episode. This podcast is for educational purposes only and does not constitute financial advice. Be sure to subscribe, leave a review, and share this episode to stay informed on the developments shaping the market.